Hello and welcome to this short video about the statement of financial position, also known as the balance sheet. And we're looking at this primarily from a user's perspective, not really an accounting perspective. So the statement of financial position is one of the three main financial statements produced annually by limited companies. The others are the income statement, also known as the profit and loss account, and the cash flow statement. The financial position of a company concerns what the company owns, called assets, and what it owes to other people, called liabilities. So here's a very simple one. First of all, we're going to look at the liabilities. Users tend to focus on what a company owes to other people and the risk of not being able to pay these people on time. These risks may be short-term or longer-term, depending on when the liabilities are payable. So there are different types here. What we call current liabilities are payable within a year. Non-current liabilities not payable till later on. What we call revenue reserves, which we'll explain later, are paid when the directors decide they're going to be paid, and the share capital and capital reserves only have to be paid out when the company is wound up. And the value of all these liabilities is shown on the statement of financial position. So here that second section has been broken down into those categories. Right, so let's explain what they are. So equity is all the money owed to shareholders, and it's made up of capital, share capital and reserves. So the share capital is the money invested by the owners of the business when they originally bought shares from the company. There are two types of reserves. There are capital reserves, which arise from certain capital transactions that we're not going to worry about here. And then you've got revenue reserves. These are retained or accumulated profits which belong to the shareholders, but they've not yet been paid to them as dividends. Sometimes these are labelled as profit and loss account on the statement of financial position. Right, non-current liabilities may be labelled as creditors due after 1 year, and these mostly comprise loans from banks and other financial institutions. And current liabilities may be labelled creditors due within 1 year, and these include things like overdrafts, money owed to the taxman, suppliers we've not yet paid, known as trade payables or trade creditors. So we just go back here. You can see the bottom half basically shows where all the money has come from, the £160,000 that has been used to buy the £160,000 worth of assets that you see at the top of the statement. Right, so let's now have a look at the assets. Having seen the potential risks, users need to know if there will be sufficient cash to settle the liabilities. Now this partly depends on how quickly the assets can be turned into cash, which is what we'll look at in a moment. It also depends on how the business generates cash, which would mean looking at the cash flow statement. Like the liabilities, conversion of assets to cash may be short-term or longer-term. So current assets are the short-term ones. They can be converted to cash within a year, and the non-current assets will take longer. So both groups of assets are shown here on the statement of financial position. So let's just have a more in-depth look at these two categories. non-current assets are also known as fixed assets, and these are things used by the company over time to carry out its activities. So land, buildings, plant and equipment, or long-term investments, by which we usually mean shares in another company. And then the current assets, these enter and leave the business regularly in the normal course of business. So we've got cash, short-term investments, inventory, also known as stock, trade receivables or trade debtors, which is customers who have not yet paid for goods or services. The non-cash current assets will normally be converted to cash within a year. Okay, so those are the assets and liabilities. The risk of a business not being able to meet its liabilities is low if the current assets significantly exceed the current liabilities, and if the total assets significantly exceed the current and non-current liabilities added together. For a more reliable assessment of short-term risk, the timing of current liabilities and current assets should be considered. For example, trade payables are often due after 30 days. Now, fortunately, trade receivables are also likely to be due within 30 days, so we can use one to pay the other quite often. However, if you're looking at the inventory, the time to sell and be paid for this would be considerably longer. So trade receivables are said to be more liquid than inventory is. If a more detailed picture of this is required, then the categories in the statement of financial position are sometimes broken down into more detail. Note that in the examples we've looked at, the value of the equity plus liabilities has always been equal to the value of the assets, which is why the financial position statement is often known as a balance sheet, because they are in balance. And the reason is because a business that wishes to buy assets can only do so by using the owner's money or borrowing from a third party or exchanging assets it already knows. So that's represented by this equation here, which is known as the accounting equation. And a final point here is that some companies prefer to present the statement in a slightly different format, which is this one here. So here the liabilities have been subtracted from the assets. So we've got a net value here of £100,000, and this is balanced by the money provided by the shareholders. So the money provided by the shareholders has gone into buying all those assets that are not covered by other types of borrowing. And that's really all you need to know about the statement of financial position. If you want further information, we've got a similar video on the income statement, and if you follow this link you will find information on related topics. I hope you found the video useful. Thank you for your attention.